Hello, and welcome to another episode of Biz Now. I'm your host, Matthew Carr. Well, we are ticking down to that July 15th deadline to have your taxes filed. And I know it might not be everybody's favorite day, but to maybe make it a little bit easier on you this year, I invited Jack Cohen from Campbell Jones and Cohen CPAs to answer some questions that we most often hear from our readers and viewers about their investments and taxes. Thank you so much for being here, Mr. Cohen.
Thank you for having me. I have a long-standing relationship with the Oxford Club, and I'm always willing to help out.
Oh, and we're glad for that. Now, before we get into some specific questions from readers, I just wanted to kind of throw this out here. What are some of the most common mistakes that you see investors make with their taxes?
Well, to start out at a big view, quite frankly, people doing their own tax returns presents a problem. Preparing tax returns today are far more complicated than they were many years ago, and maybe if you just have a W-2, you could use TurboTax, but there's a lot more to it, and even in a CPA firm, as I tell our preparers, just because you get a green check mark when you're preparing a return online does not necessarily mean that the return is correct, and so that's number one. And this first one is a very, very common thing I see. And that has to do with people that have capital loss carryforwards. Many people lost a lot of money in that last recession, and they have these huge capital loss carryforwards. And what's amazing is that most people who invest, they'll look into their investment portfolio before the end of the year to try and determine what they should sell, wanting to maybe sell stocks that are at a loss, but this is going to be counterintuitive. I'll tell people, when you look at your portfolio at the end of the year, look at your open positions, and if you have capital loss carryforwards and you have stocks that have appreciated in value, in order to use up some of the losses, sometimes it makes sense to sell the stock and then rebuy it again 10 minutes later. Again, for losses, you can't do that, but for capital gains that you can. And it's just a way to use up some of these capital losses, because, you have hundreds of thousands of dollars in losses and you can only claim $3,000 a year. You'd have to live 100 years to be able to use them up. Yeah. So I'd say that's one thing I think people should take a look at at the end of the year, when they want to kind of take a look at their portfolio. I think the other thing they need to consider too is when they actually sell stocks, make sure that they have it at least a year so they could get the benefit of capital gain rates. And sometimes people, they'll be focused on selling, but maybe they hold the stock one more day, and instead of paying ordinary income, now they pay capital gain income. So and then even if you move away from, say, stock investments, I mean, people have tons of other investments in real estate, and so routinely we see, again, people, what does my one partner tell me? You have to kind of stay in your lane. And people could be really smart at some things, but taxes is something that they're not that good at, and they shouldn't be. That's not what they do for a living.
Okay, those are some very excellent points. Now this is a question that we hear probably more than anything else, and that is, what happens if you hold a master limited partnership or an MLP in a tax deferred account?
Okay. So one of the questions we get a lot, or one of the things we see a lot, is, how people invest their money when they have it in a tax deferred account, like a pension plan. And the truth is that, in my opinion, at least, there's many things that really are not suitable to be held in, say, a tax deferred account like a pension plan. And the reason is because certain investments you make have certain tax attributes that go along with it that you lose in a pension plan. And give me 1 second, and I'll go back to the master limited partnerships. But an easy example would be people who hold real estate in a pension plan. Well, one of the great attributes of real estate is that losses many times in real estate can be used to offset your other income. Well, in a pension plan, losses aren't going to help you at all. The other issue is the benefit of capital gains that real estate holds. If you own it personally, you get capital gains when you sell it. If it's in a pension plan, you don't get capital gains. And when it comes to investments like master limited partnerships, again, if there's any losses, say routinely, if it would be, let's say, an oil and gas investment because of the rules having to do with oil and gas, many times it'll generate a loss. Well, it's not going to help you inside a pension plan. Okay. So, and then the other thing is, and I think we were going to cover this later, but maybe just touch on it now. I know it has to do with unrelated business taxable income.
Yeah.
And so a quick overview of this, and again, we do see this a lot. Investments within a pension plan, if you have passive investments, it's not a problem. But if that investment is really like an operating company, okay, the IRS has rules that say you can't take income that you normally would have had to report as income on your tax return, and then by putting it in a non-taxable entity like a pension plan, not pay tax. They actually have a separate tax calculation. And the easiest way to explain this, and I do this all the time, is take our accounting firm. I have I don't know, 2 other partners, and every year, whatever our accounting firm makes, we have to report our share on our personal return. Well, if we didn't own the firm and our pension plan owned the firm, basically we wouldn't pay income tax on the profits. Well, the IRS sees that as kind of like a tax motivated transaction. And if you did that, they actually have a separate tax rate for that. And so that's something that, often people encounter when they invest in master limited partnerships, that sometimes there could be unrelated business taxable income within that entity.
Okay. Excellent. Now I'm going to read this question because this is one that was brought in, but this relates back to MLPs and K1s. But it also says, in some partnership K1s suggest that the income from the K1 may be taxable in states where the investor does not reside, requiring you to file a tax return there, assuming there is enough income to trigger that requirement. So how should investors handle that?
That is a great question. And since my clients are literally not only all over the United States, but all over the world, we often encounter that. And generally, so let's start out. Each state pretty much wants a piece of the action, so to speak. And so if you have income in their state, they would want you to file a tax return. And some states are certainly more aggressive than others. Because remember, when that investment return gets filed, and they have K1s for all these other states, the IRS has an information sharing agreement with all these states. So the states are getting copies of all the K1s. I like to think we take a practical approach to this. In many cases, it doesn't cost hardly much more money just to file the state return. Let's use California, for example. That's very, very aggressive. Many times, if we get a K1 from California, we'll file the California return, even if there's no tax due, just to kind of preclude California coming back and chasing our client down. If the K1 has losses, sometimes we won't do it. Especially if the K1 has very small losses, we won't do it. So what normally will happen is we'll kind of have a discussion with our client and say, listen, you got K1s for 10 different states. We can file all the state returns if you want, or we can not file them, or we can just go through them. Sometimes we'll pick out the more significant states. Say a majority of the income would be California, and 5 other states have hardly any income proportion to it. Maybe we'll just file the one state return. So the general rule would be that the states would want you to file a return if you have any income that's generated in their state. But then we kind of take a practical approach to that, if that makes any sense.
Okay. Now I have another question here, which is, are municipal bonds really tax-free?
Well, I actually think it depends on the bonds, because some of them could be, and again, more likely for state tax purposes, this is an issue, is that some states would have only the tax-frees for bonds issued in their state. And so again, for federal purposes, they're going to be tax-free. But again, the state returns are a little more problematic. And so we have many clients that have tons of investments in municipal bonds. And basically what we do is we have to go through and figure out the source of where the bonds were issued. And in some cases, if it was issued within that state, they'll be tax-free, and in some cases they won't. And so again, this is just another great example where, if people are not familiar with all the rules of all the different states, I mean, they could run into a problem, not so much with the Internal Revenue Service, but the states. And let me just say this, I've been doing this for a long time. Nobody likes getting a letter from the IRS or from the state, because generally 99 times out of 100, it's not like they're sending you a check back. If you get a letter, it's usually a bad newsletter. So
good advice. Now, one final question for you. Can you kind of explain, let's say if we have an international investments and how those are taxed and how investors should maybe kind of deal with those?
Great question. And it happens more often than not. There's a whole bunch of rules that apply to U.S. citizens that have investments in other countries. So the first rule is, this is an easy one. If you're a U.S. citizen, you are responsible for reporting your worldwide income. So if you have income in any other country, now many times we'll have to convert foreign currency into U.S. currency, but if you have investments that generate income in any other country, you have to report it on your U.S. tax return. That's rule number one. Certainly, if you had to actually pay income tax to the other country, the IRS, the United States, has tax treaties with many, many of these other countries, so you don't have to pay tax to both countries on the same income. And so, for example, if you had to pay tax to France, as an example, when you file your U.S. return and you report your income from France, you would get a credit either as a deduction or as a foreign tax paid to how much you paid to France. So you have to put the income on your U.S. return. However, there's even more rules, and there's one rule that they refer to as FBARs. That's FBAR. I can't even remember what it stands for. Basically, it says that if you have any more than $10,000 in cash or cash equivalents in a foreign bank account, you actually have to file a separate return with the Internal Revenue Service, just notifying the government that you have these accounts. So it doesn't necessarily affect tax. It's kind of like a big brother watching you, and they want to know how much money you have in these foreign bank accounts. In addition, there's another rule that says if it's in other accounts other than bank accounts, if it's still in cash or cash equivalents or stock accounts, let's just say, there's another form that you have to file with Internal Revenue Service to notify them of that. And there's a pretty high threshold on that. I think it may be like $250,000. I'm not sure. I'd have to check. But with both those forms, there's no, like I tell clients all the time, if there's any doubt that either of those apply to you, you file the forms, because there's generally no tax that's associated with it. However, there's huge penalties if they catch you for not doing that. I just read a court case the other day where they assessed hundreds and hundreds of thousands of dollars against someone for not reporting those foreign assets. And so, again, the average person wouldn't know that. And so it's really easy to comply with the Internal Revenue Service rules on those forms. It doesn't cost hardly any more to do this. Just do it and be compliant and not have to worry that one day they're going to figure out that you have, $100,000 in a foreign bank account and you never put it on your return. Yeah. Bad idea.
Do you have any final words of wisdom for investors out there?
Well, again, all I can say is that I myself am not any kind of a financial wizard, and that's why they belong to the Oxford Club. So they get great investment advice from Oxford Club. I think, though, that I am a great resource for the tax implications of people's investments, and it doesn't even have to be me. I mean, I would say most CPAs can probably help out with a lot of this stuff, but I would say the biggest problem is to not know what you don't know, and that's why many times we'll take a look at people's returns that have either been prepared by themselves or by other CPAs, and so it's great. It's a great idea to get a second opinion. We do this for the Oxford Club members for no charge. But again, people, we often find people who've been preparing their returns on their own for many years, and eventually, they all come to the realization this is a really bad idea. And how often do we hear people say, "Well, I've been doing my own returns for years. I never got audited." Well, that doesn't prove anything. Your return could be totally wrong. You could have missed. I mean, we look at returns where people literally missed hundreds of thousands of dollars and wouldn't even know about it. And just because they got a green check mark and they didn't get audited, they think they did a great job. And so, I can't do. I'm not an expert in fields that my clients are experts in. I'm not a cardiologist or a chiropractor. All I do is taxes. And so all I can say is that it's not a bad idea to consider either using a tax professional or at least consulting with a tax professional.
Those are sage words from Jack, and why you should be using or at least consulting with a tax professional. A lot of this stuff is extremely complicated, and you could be leaving not just a few bucks, but tens of thousands and even hundreds of thousands of dollars on the table. I want to thank Jack Cohen from Campbell, Jones and Cohen CPAs for being with me today. Thank you, sir.
Thank you for having me. It's absolutely a pleasure to work with you guys. Thank you very much.
And from everyone here at BizNow, thank you for watching. I'm your host, Matthew Carr. And until next time, here's to high returns.